Hey there, everyone. Welcome to the Final Bar. It's Thursday, July 25th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the power of the Stockcharts platform. Our platform was designed over 25 years ago to empower online investors to better understand the markets through the lens of technical analysis, investor sentiment, and psychology, and really equipping them with the tools that they need to analyze the markets and trade them more effectively. I would say in a bull market phase, when everything's working, you can get away with all sorts of bad habits. In a pullback, in a corrective phase, in a distribution phase, all of which I think are fair ways to describe what we're experiencing here in July of 2024, bad habits start to can be quite overwhelming, right? And all the things that you got away with when everything's working, this is where you start to really recognize some potential weaknesses in your process. We hope that stock charts can be a part of the way that you address those weaknesses, and hopefully we can take advantage of some of the tools here on the show today. Another distribution day here for stocks, really strength through midday, but the afternoon right back down below the zero line. So with that in mind, let's look at this distribution day in our market recap and see what we learned from the analysis of the individual charts here. Here's this sort of upside down V that was the story of the day today. We actually opened slightly lower on the S&P 500, bounced up to almost hit 5,500 today, but by the close, we're all the way back down just slightly below 5,400. That's where we ended up down about 0.5%. It was up quite a bit midday, probably about 1% higher before rotating back to the downside. The Nasdaq, of course, continuing to lead the way lower. Those growthy leadership names that were just so powerful on the way up also are the downside catalysts. They're powerful on the way down as well. Mid-caps finished up about 0.9%. The S&P 600 small cap index, the best performer, up 1.4%. Hope you were able to participate in my free webinar yesterday called Small Caps, Big Dreams, the Great Rotation of 2024. We talked about potential strength in small cap and why some of the macro headwinds for mega cap stocks are actually tailwinds for small cap stocks. Today, yet again, we're seeing small caps seeming to thrive there. Don't forget the scanning engine, by the way. If you are looking for small cap ideas, great way to filter all of those small cap names, many of which you probably don't know. Filter them on constructive technical configurations. The VIX did end up pushing slightly higher. It was going lower earlier in the day, but by the close, it tends to have an inverse relationship to the S&P. So as the S&P and the Nasdaq sold off in the afternoon, the VIX pushed right back up higher than where we started, right around 18.5. So we are above 15, which in my opinion means pullback range for the VIX, kind of between 15 and 20. VIX starts spiking above 20. I think you have to think of this more as a deeper corrective move. VIX above like 28, 29 is where things can really get dicey. So we're still sort of in that early corrective move according to the volatility framework. Interest rates overall moving slightly lower. It wasn't that bad of a day, though. The 10-year yield finished around 4.25. The long bond yield right at almost exactly at 4.5. The dollar index, no real change from yesterday. Bond prices slightly higher from Wednesday's close. On the commodity side, you can see that some areas of the commodity market, particularly crude oil and copper, actually finished up today. But gold and silver, precious metals, actually, really opened lower and just didn't gain any sort of ground. I was interested in the afternoon as stocks started to sell off to see if gold would start to rally as a bit of a safety trade. Was not the case. The GLD actually finished down about 1.6%. Silver, the SLV, finished down almost 4% today. Also, almost all of the top 10 cryptocurrencies that we track on our platform in the red today. Bitcoin down only 1% from yesterday. Ether prices down another 6.5% to 7%. So you're continuing to see deterioration, really just a lack of upside follow through in the crypto space as we continue on here, getting toward the end of July. Looking at the 11 S&P sectors, you can see 4 out of the 11 managed to finish in the green. Energy, your top performer by far, up 1.6%. Industrials number 2, up 0.8%. Financials number 3, up about 0.5%. On the downside, some growthy stuff at the bottom. Communication services, technology, both down about 1.1% from Wednesday's close. Utilities and REITs, your third and fourth from the bottom. So, arguably, at the top of the list, it's some value-oriented sectors, the MEI sectors, materials, energy, industrials, financials as well. I have a series of charts on my Mindful Investor Live chart list where I group the sectors by sort of the type of sector, and I have a value chart with those 4 top performers from today relative to the S&P. All 4 of them had a decent day of continued outperformance. That has certainly been a trend that we've observed here over the last couple weeks. Looking at the Magnificent Seven and friends, of course, we had some earnings right earlier this week with Tesla and Alphabet. Tesla actually having a nice counter trend bounce today, up about 2%. But the rest of these mega cap leadership names, or I should say previous leadership names, on the downside. Alphabet, your worst performer of this group, down over 3%. Microsoft down about 2.5%. From Wednesday's close. Let's go to a daily chart of the S&P 500 and see how things sort of played out today. So, yesterday we talked about that break below the trend line support, a close below that trend line for the first time. And the question was, do we get a follow-through day? And a follow-through day, I don't have a specific set of rules that define a follow-through day. For me, it's the general sense that the market continues in the direction of the breakdown. So if we have an initial break lower and we close below a support level or a trend line, do we continue down the next day? And that additional movement basically suggests that it's not just a whipsaw, people are buying in on the weakness kind of move. It feels more like the beginning of something worse kind of move. Now, earlier in the day, the S&P 500 almost narrowly went back above that trend line. So I'm watching this in the afternoon around lunchtime Eastern, thinking, all right, maybe this is a rebound day, and we don't get that follow through. But boy, you tell a lot. This is why we wait for the close as a technical analyst, because between the open and the close, a lot can happen. Arguably, a lot of that's noise. In the end, what did we do directionally? And the answer is we went even further down. The S&P confirming, I would argue, a breakdown below trendline support. I think that's a very concerning development. We are now closing below the 50-day moving average for the first time since early May. And now we're almost to the penny, right at that, price gap from earlier in June. We talked about 5,400 as being the line in the sand. We're literally there today at the close. So I think going into Friday's session and then certainly in the beginning of next week, the question is, do you find support here, right? Do we hold at that price gap from June? Do we, just manage to make it a one-day phenomenon of closing below the 50-day moving average? I find myself incredibly skeptical that this would be the end of this pullback. It certainly is giving all the signs that this is start of a much deeper sort of protracted decline. However, price is what's most important. What's interesting tomorrow is you have the PCE data, excuse me, the favorite inflation reading allegedly of the Fed. So we'll see what sort of reading we get there and what that means. Also, quite a bit of earnings continue to come in here. The Magnificent Seven names reporting were earlier in the week, but this week and then certainly into next week have a lot more earnings. We've got a Fed meeting coming up as well. So a lot of potential catalysts. And again, we're one bad headline, I feel like, away from a much deeper corrective sort of move. Worth noting today, the RSI below 40, and that might be an interesting data point as well. Now, back in April, to be fair, we did go lower than where we're at. We're kind of here right now, right? We're touching the 50-day, and we closed below it. We had about another week of a downtrend in April. The RSI got all the way down almost to 30 before continuing the uptrend, which is actually kind of unusual. Usually in an uptrend phase, the RSI doesn't get much below 40. So I think something to watch here, again, through tomorrow and then into the beginning of next week. See if this is able to find some footing. But I think for me, the fact that we've broken down through that trend line immediately has me starting to think that this is the beginning of something deeper. Getting below 5,400 into the weekend would be a big exclamation point on that distribution phase. It tells you that buyers are just not coming in a meaningful enough way to stem the tide of this selling pressure. Now, the VIX, of course, pushed a little bit higher here today, currently around 18.5. And as I mentioned, we're still kind of in the, pullback range. Below 15, I think we're in an uptrend between 15 and 20. And this is a total generalization, by the way. This is not a hard and fast rule. But between 15 and 20, we're probably in a pullback. Up 20 to 28.5 means we're probably in a deeper, more protracted decline. VIX above 29, we're in that type of market where you want to be out and defensive. You want to just be waiting because we are most likely in a severe decline, one of those really meaningful bear phases. So again, a lot more upside to volatility, which could potentially certainly imply downside for the major averages. I just want to talk briefly about what we call Dow Theory. Here's the S&P 500 in the top panel, the Nasdaq Composite in the bottom panel. Both of these, of course, made new 52-week highs just a couple weeks ago. But of course, since then, the last week and a half, 2 weeks have been a lower move. Now, here's my preferred way of measuring this is using the equal weighted S&P and the equal weighted Nasdaq 100. The reason why I want to bring this up is according to a strict analysis of Dow Theory, or certainly what Charles Dow was implying, until you get a confirmed break below previous support, it's still bullish, right? So we did have a breakout earlier in July. So overall, I would say that this indicator is bullish until proven otherwise. And I'll draw real time here, sort of the levels that I'd be looking at. I'd be looking at sort of that level on the equal weighted S&P. I'd be looking at this level on the equal weighted Nasdaq. And the general rule of thumb is as long as we hold those levels on pullbacks, this market is not too bad. We start to break below those red dashed horizontal lines. That tells you that we are then in a confirmed bearish pattern. We really didn't get any sort of disagreement, any sort of divergence between these two data series in July. Both of them made new highs, which is, again, a bull confirmed pattern, but they both break below the April low. That would be a bear confirmed pattern. And again, the disaster scenario for stocks going into August, September, and potentially into September, October low, an indicator like this would probably flash a sell signal. Has not yet. And again, that shows you the decline we can have and still be within sort of the framework of a pullback without getting getting too ugly there. Let's look at sentiment. So in my Mindful Investor live chart list, I have a couple sentiment indicators. The VIX, I would say, is a good sentiment gauge. I do want to mention the AAII survey. This is a weekly survey called the American Association of Individual Investors. This is a weekly survey that's been run for decades by this organization, surveying their members who are mostly, as implied by the title, individual investors. And the question is basically, are you bullish, bearish, or neutral on stocks for the next 6 months? You can see that last week we were just slightly over 50%. As I mentioned, number just over 50% means you're in a sort of a euphoric range for the AAII bullish reading. The market can certainly go up in that condition, but it tells me to start looking for signs of a rotation lower. This week, by the way, and that reading just hit today, the number went down from around 51% to around 43%. The number of bears went from around 23% to down around 32%. So basically, you had a bunch of respondents either rotating from bullish to neutral and neutral to bearish, or some sort of pattern there. But to be honest with you, this certainly suggests that individual investors after this week are really starting to recognize and appreciate the downside potential in this market. And I think what's so striking here, we have a bit of a disagreement over the last month between the two main sentiment indicators I use besides the AAII survey. I also look at the name exposure index, which are money managers. And as you can see from that survey over the last 3 weeks, that actually went from around 105% allocation to equities 3 weeks ago to around 77% today, which is actually in line with basically the long-term average of this reading through bullish and bearish cycle. So this indicator went from leverage long a couple weeks ago to now more, a market weight. And what that tells you is over the last couple weeks, as individual investors have been pressing the gas and been extra euphoric, money managers, at least in this survey, have been lightening up and selling into strength. And for now, certainly seems like the smart money, I guess, for lack of a better term, has really appreciated the downside risks, and now in some ways being proven right, at least for now, that deserves a lighter allocation, and certainly with potential of further downside. I do want to show the market carpet. A number of people mentioned you thought this was a great visualization. I totally agree. And what I love about this is that a lot of the point of a heat map like this is to help you focus on what's actionable, right? What really moved. And if you look at a group of stocks like we're doing here, look at a group of ETFs or whatever industry groups, whatever you think is important, it really helps you to take a big, large number. These are 500 stocks represented on my screen right now, and really focus on the actionable things, right? Which are the brightest green and the brightest red? Those are the things really moving. And you'll notice Alphabet, Microsoft, AMD, Qualcomm, in terms of the growth sectors, really feeling the pain today. It's not as bad as yesterday, right? So you are seeing stocks like Apple only down 0.5%. That's not too bad. Still not obviously going up, but not going down. But IBM, ServiceNow, which is an earnings name, Salesforce, actually doing just fine. You can see elsewhere in consumer discretionary, a bit of a differentiation between certain stocks doing quite well and others struggling. So today, a little more of a mixed day in terms of the individual names and opportunities, but a lot of red kind of across sectors, right? I mean, I feel like every one of the sectors you find at least a couple names that had a tough day and a couple names that actually had a pretty decent day. So I would argue really good time to be a stock picker, really good time to focus on what's working, particularly in a down tape. Owning things that are going up when the benchmarks are going down is a brilliant way to outperform in a bearish phase, right? Find things that are either going down less or at least appreciating. And I would highlight sectors like financials, like industrials, like materials, like energy, consumer staples, actually showing quite a bit of green on a day that ended up being kind of a negative day for stocks. Let's finish off looking at some individual names. NVIDIA, one of those stocks that certainly bears watching. Bears watching because of the size in the XLK and certainly in the Qs and the S&P. NVIDIA today, you'd probably call this. I don't know if I would call this a doji candle because the open and the close are not at the same level. It's sort of a weird. I don't know if I would label this candle. I'd originally thought this is maybe a doji candle, but it's changed a little bit. From when I looked at it before. I probably wouldn't. What strikes me on the chart of NVIDIA when I bring it up, I'm immediately drawn to these bearish engulfing patterns. This is a great, future textbooks on candlestick analysis should include this example of, just short-term distribution and short-term swings within a larger term trend, right? If you're a short-term swing trader, you have the opportunity to bet on swings regardless of what the larger term trend is. And I still think that's important to pay attention to for sure. But overall, I think it's a great testament to the value of looking at candle patterns, particularly when you make a new high but then close lower. That's a classic distribution pattern called a bearish engulfing pattern. I wonder if Meta. So Meta also as well. So a number of these actually sold off going into the close. Earlier, NVIDIA actually looked like a much more constructive candle. Meta was actually almost a hammer candle, but at this point, the body of the candle is almost half of the whole candle. So I don't think you could label that a hammer candle anymore. It's certainly not an idealized one by any stretch. So, a lot of these stocks that actually look like they might be giving a sign of short-term optimism going into the close, not doing so. And again, Alphabet's sort of just even worse, right? This is a stock that gapped down yesterday below the 50-day moving average, and then today just pressing the downside. So you have signs on some of these leading names that we're not done, right? That at least, for today's session and going into tomorrow, distribution's the name of the day. And you're seeing stocks accelerate to the downside, unable to find their footing, additional buyers not coming in and buying in on weakness. This is still a market in risk-off mode. In terms of earnings, you had a bunch of things. I'll get away from the zoomed-in candle chart, just kind of walk through some of the larger themes. ServiceNow, you might have noticed on the market carpet, one of the bright green spots in the technology sector. This is a software name you can see making a new all-time high today. How about that? So, again, one of the great benefits of looking at the market carpet, looking at our dashboard, is that you can recognize, even on a distribution day, there are stocks that are going up. And that's usually the case, right? Even when things seem incredibly dire, something somewhere is working. It's just a question of using the tools available to you to identify those opportunities. ServiceNow gapping higher today. Nice earnings report, popping higher today, about 13% to the upside, making a new all-time high. The question is, can we sustain that break above 800, which has been resistance for the last, really through most of 2024. We recently hit that in early July. Right around the 4th of July holiday, we pop back to the 50-day and now pushed higher. So overall, I think this is a chart that deserves being innocent until proven guilty. But for now, I'm not seeing any guilt on that chart. I'm seeing upside pushing to the upside or further upside. UHS is Universal Health Services. This is a healthcare name, actually making a new 52-week high today. What I like about this one, recent pullback to the 50-day moving average. And for much of July, it certainly felt like we were just sort of languishing between around 177, we'll call it, and 185. Today, really pushing through to the upside, up over 10%. And again, I think that breakout is pretty good. On a chart like this, my initial sort of stop, and again, make just as an initial assessment on this chart, I often use the breakout level as that initial stop, right? If you have the ability to buy in on that breakout, use that breakout level as a stop, because as long as we hold that, then it's all gravy above that entry point, right? Anything above the breakout is good. Maybe your secondary stop could be, the swing low around 177. That would be the low from July so far. So you have a couple stops on the way down to limit your downside, but you have all the upside if this thing continues to work. And again, a chart that is clearly trending higher when many things no longer appear to be doing so. Do want to mention airlines. I don't know if you live in a big Southwest city, but huge news if you're used to the cattle call of a Southwest boarding process where you stand in the line, you get called up by your group or whatever. I've not lived in a Southwest city very often, but I will tell you that the news is that that's going away, which is probably great news for people that never really like that, like myself. For some that have gotten used to it, sorry, life is about change and adjustment. But for what it's worth, a lot of the airline stocks, not particularly related to that Southwest news, but certainly showing some upside potential, and it's bullish engulfing patterns, right? Here's American Airlines, lower open today, but closing higher. That's bouncing off of $10 a share, which is often a really interesting, big round number where you find support. Here's Southwest dropping the news yesterday or into the open today. Down day yesterday, big up day today. I would say American Airlines certainly looks like it's a better reversal. Southwest has had this bullish engulfing pattern right up into a very congested area of resistance, but overall, this is certainly telling you in the short term you're getting some optimism in airlines, which has been few and far between for quite some time. Things that did not work today, and again, a couple of these just classic examples of charts in a downtrend. And again, it kills me when people ask about Lululemon and say, what do I do now? And implying that they bought it a while ago and they're just sitting on this declining stock and wondering what to do. My answer is have a much better money management process before today, right? If you're still holding it today, you've been ignoring, I would argue, a lot of clear technical evidence. I mean, really count the number of things from like mid-January to mid-April that would have told you this is no longer a great stock to own. We went from being above an upward sloping 50-day moving average to breaking below the 50-day. We had a breakout in March that failed, a failed breakout that immediately turned into a gap lower. It went below the 200-day moving average. That should be enough, I think, for many. And then just no buying power coming in, right? No buyers coming in thinking, great, I get to buy Lululemon at 380. There's just additional selling, and all of a sudden we're down to 250. So while the gap lower today certainly does not feel particularly good, hopefully this is the type of chart you've been avoiding for a while because it's had a declining primary trend. We're below two downward sloping moving averages. The momentum overall is negative. The relative strength is down. So if you've been holding names like this, I would say print this chart out. Put it on your wall, tape it to your monitor, and just remember, if you see something earlier on, like think about what you would have seen and what signals you could have identified to keep you out of a name like that, and just make sure you avoid it the next time. LVS is another one, again, in a primary downtrend below two downward sloping moving averages, making a new 52-week low today, really getting down to sort of the 2023 lows. And on a chart like this, when you really get to the downside, I like to do the unadjusted data because it pays a dividend. And then I like to look at the weekly chart because then you really get a sense of what longer term support levels may be in play. Here we can see a stock that's bottomed out a number of times, sort of in that $30 to $33 range. That might be the next downside objective given the distribution we've seen so far. And again, the momentum, the trend overall, quite negative still on LVS. Final one, waste management. Let's go back to the daily chart here. But what's interesting about WM is looked really good in mid-July, and this is the challenge with earnings with individual stocks. They can gap, and gaps are one of the toughest things for investors to deal with because they're often sudden and many times unexpected. That is the reality. That is the reality of investing in individual stocks and often in ETFs. That is one of the risks is that gap risk or that company-specific risk that could cause a stock to gap up or down. Now, I have been rolling over for a couple days going into today's drop. I'm concerned by the fact that while we bounced back up to the 50-day, that just was met with additional selling. We got all the way down to $200 a share. We're right at the June low. So I think this is a key level to watch for WM. It holds 200, and it's, I guess, not the end of the world. And maybe you can look for some opportunities to, for a trade back to retest some previous resistance levels. But we break 200. You got the 200-day moving average not too far below. But I mean, overall, the momentum is really negative at this point. It certainly seems less and less likely that level may actually hold. So I'd be setting an alert there and see tomorrow into next week if we're able to find our footing around 200. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. We have a special all mailbag edition for you tomorrow on Friday. Then we'll be back with our regular show on Monday. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.